Good turnaround Tuesday, Warriors. How you doing, Michael Weissman? Sinatra? Rand, why do you think there'll be big interest in webinars today? Hi, team. What's new?
Morning, Dale.
Yeah, how are you, Ryan? So why don't we start with well, the Dixie, you know, if it didn't have a CPI, I might try a fade for a lower high here. Tell me, you know, weakness going into the ECB. Is there anything you would fade here today, Ryan?
I've had a little nibble. I've had a little nibble at euro dollar down at 110, 107.10, just to play this 107 big figure, 106.90 support there. Nothing more than a scalp. I'm not looking for retire on it.
Yeah, maybe something like this, huh, Ryan? Where that's what I was looking at in the dollar. You have a higher low here, lower high in the dollar, and you get maybe something like this, you know?
Yeah.
Towards 108. All right, nice. Kman, we're trying to get into the gap. You know, I'm going to wait for the CPI because in case it's hot. Anything you're looking to do here as it approaches the gap lower from Asia and Sunday night?
Yeah, good morning, Dale. Good morning, everybody.
How are you?
I feel more like a high-frequency trading program right now. I've got stuff in position for literally 10 pips and things like that at times when I just see fit. I was a bit short cable towards the high yesterday, and I bought this back this morning, and that's my mindset until that tomorrow CPI is just like, don't try to go for breaks or things. And I mean, it can break.
Keep powder dry. Keep powder dry.
It can break. It's an FX market. Everything can break at any time. Yeah, and on the yen, as you were saying, it's I wouldn't rule out anything, but the way it came back higher suggests that the yen is not yet ready to sustainably rally, but I can imagine some speculation coming into the market ahead of the next Bank of Japan. So I think the prior high is a bit far reached, but I mean, there's as you say, there is no nothing that really holds it back to try and go and have a test back in the 147s. That spike high just after on Sunday night, you know, after we gapped lower, there's this little spike high in the just in the 147.25 zone there. That one, you know, after we gap low, that one I think may be a bit interesting. If that would go, I suspect some short-term shorts will run for the exit, but that may be the perfect time to give it a knock on the head, perhaps before the CPIs. But over CPIs, I won't have much to know. I'm just a base position short in euro dollar, but that's it. And the rest, my very long-term silver, but I'm so patient with that. It's just in the fridge right now, you know. And for the rest, really, I'm really trying to just nick pips when I see something popping up, and that's it, really.
Okay. Gold looking pretty heavy to me if this was a flag. So I know that
you've been saying it for days, huh? That those metals are not enjoying much right now. It's probably just you know.
I'm actually looking for this. I may start at 1840, but actually looking for this. You know, what may be the biggest catalyst would be more risk off after this rally. So when we get to the S&Ps, because yesterday I said, you know, I'm looking at short around 4,500. And then Blake came up with his little mini head and shoulders formation that targeted the 4501 level, and close enough for government work, 4497.20. So that looks heavy, kind of like just a retrace. I had this line drawn a couple weeks ago as being like a key pivot point, and because you look left, it was, and then once it broke it last week, we had a nice break, so thought it might be a place where it could get rejected.
Those both ends of the 4500 and 44, what is it, 3040 there could be like really good markets to go into tomorrow's CPI.
Yeah.
If it really overshoots, like the risk, some people are calling it a possible risk, then your 4500 is going to be a very good level to lean against, and at least your stops will be clear.
Yeah, over the 45.40 high, but not at 45.40.10 buy stop. You give it 10 handles or so.
Yeah, always give it some algo pips.
Yeah, I like that term. All
right.
right.
You always, on your stops, you always have to give some algo pips, because there are stops bang on levels. People still haven't understood that you don't need to stop bang on a level. So there's always going to be those 6, 7, 8 pips overshooting, and then perhaps take the other side.
So you changed me from just talking about a stop hunt, but stop hunt for algo pips. So I like it. So
because an algo that doesn't doesn't protect your stop. It sees the number and it just executes.
It's a magnet.
Well,
sometimes
no, it's just a fact. They look at the liquidity. If the liquidity is not there at 44.99 and then 4500, they will pay up 4501 or 2 or 3 until the order is filled, and that's it. And it's just the way they're programmed.
Yeah, I remember on the floor you would actually hear an audible roar as stops were elected over important areas. And
you were one of those, weren't you, Dale? You were the Forex stop hunter.
Off the chalkboard at the IMM. So they were trading currencies on a chalkboard. Is that amazing?
Yeah.
They would change the bid and offer and last sale and everything with chalk. So anyway, I have a bearish bias in the S&Ps. As something I just want to show to keep an eye on is that Microsoft topped before the major top, and it had this huge earnings move here, and this was a pretty good break. Talking about $55, and with this recovery that we had to 4,600, we hadn't even recovered 50% here in Microsoft. I actually think it's a decent short between here and 61.8, because if there is a correction and it's not over yet, I think we could see 290 again, maybe work its way back into the gap. And Nvidia is, barely hanging on. It's called about $3 lower. Look at this glaring divergence in Nvidia. So what did I? Oh yeah, I ended the interview with Peter Bookfire yesterday, and I said, any last thoughts, like mortgaging your house and loading up on calls in Nvidia? Probably people doing that. So this is really the poster child for the AI craze. So it looks vulnerable to me. So risk off. That's it took me 15 minutes to do it, but maybe that's what's going to be behind this rinse in gold. Because when you look at them, they really, for the most part, when the S&Ps are rallying, so is gold. They're not trading, it's all one market still. It's all one market. So you know, that this could be the S&P's rolling over and taking out that recent low could be the catalyst for gold getting smashed again. So there it is. There's a picture. I haven't removed my squiggly line because I know there's a lot of people out there that want to copy it. It's kind of technical Picasso stuff on my chart. So
Dale,
anyway,
the day you build an indicator that takes the price back in time, then you're going to be a rich man.
working on it, bro. So anyway, you know, just kind of play it close to the vest today in front of the CPI, Blake.
Good morning, guys.
Good morning, buddy.
Good morning, Dale. Ryan, Kman. Yeah, you know, I think Kman has it right there. You know, you just got to play for, if you're going to play and you're going to be establishing trades, they got to be really short term. I mean, tomorrow's we're going to be a little, you know, obviously defensive until we get till tomorrow. We do have the iPhone event today. So they're going to, you know, Apple's going to release the details on the new iPhone 15. Could be a bit of a mover because, you know, we've seen Apple come down, you know, out of that ascending, the ascending wedge, you know, a couple of weeks back, and then we filled the gap. And, you know, I think we're here. I'll show you just because I have a fib level drawn here, and which is no offense to your squiggly lines, Dale.
Well,
but,
I want to see it. I have a position there. I'd like to see your look.
Mine looks a little cleaner. All right. So coming out of the ascending wedge here, we broke down,
Right.
you know, and you can see this was set up from before. We had a RSI breakdown, almost hit the 38% retracement, came back, filled the gap. Chinese news, China, you know, prohibiting iPhone sales, blah, blah, blah. We rolled over again. You can see how important this support is. And, you know, normally I wouldn't really care. But you know, it is Apple, and
everyone owns Apple, Blake.
Everybody owns Apple. And you were talking about the S&P, and yeah, we had that inverted head and shoulder pattern. We did complete that yesterday, or pretty damn close. You know, I had it completing just a couple pips higher, but as you pointed out, we came within a couple of pips, and yeah, and it's rolling over where it should. Matter of fact, there's a lot of things rolling over where they should, and we'll talk about those here in a second because I think it's important for currencies. But given that the S&P is kind of rolling over there, you know, it does make the market vulnerable, especially if Apple starts coming off. So I think that's, you know, when you have a day when there's no real news, no economic data that's going to move the needle, that we don't think anyway, then you start looking around, and Apple is one of those catalysts that could be a driver and push us outside of this channel and maybe back below, you know, 44.50 ahead of the inflation data. I mean, I'm expecting hotter data, but so is everybody else, right? Like everybody's expecting. Everybody's expecting a fairly hot print. I guess how hot is kind of like the porridge, you know. It's like the berries in the porridge, you know. It's if it's too hot, it's gonna really weigh on markets. But you know, a hot number or around expectations, you know, might keep the market fairly contained. I think this 44.50 is going to be pretty critical when you're talking about the S&P. But I want to talk about really quick. I want to talk about currencies because we saw the euro rejected. You know, this is the previous support, current resistance. You can, you know, see in the bias chart, we are, you know, looked at the 107.65 as being key resistance yesterday in the euro. And I mean, we went within, you know, 4 pips of that, reversed. But it looks like, and Kman and Ryan, maybe you guys can confirm since, you know, we were sleeping. Looks like everything reversed right after that UK data came out. You know, you had the you know, pound kind of spike up and then reverse again. And we had some decent Eurozone German WPI data came out a little bit better than expected. So what is that basically what happened? Like you saw everything spike up and reverse at once?
Yeah, a little bit. You know, the market on the pound took the headline numbers and the wages, and then hit it on the rest of it. So the jobs report wasn't all that great, and it's been grinding lower. But I think it's just more a bit of dollar in there as well. You know, the dollar was a bit weaker yesterday. It's a bit stronger today. You know, dollar yen's trying to tap that 147, but keeps banging its head. So you can see we obviously had the big move down from UEDA, then the bounce, failure at 147, and it's doing its grinding thing since 146.20. And you know what happens when it grinds and grinds and grinds, and I should think 147 is not long in breaking. Oh, it's gone now. There you go.
Yeah, you know, yesterday
looking at his screen.
What's that?
And no, he's calling for the break just as he looks at his screen. What a good call, Ryan. Good.
Yeah, well, I did say it on the flow show, so yeah. But yeah, just ticking through now, having a go.
So you know, I was looking at the lows yesterday, and you can see from yesterday and then last week, and then I pulled up the 6J yesterday, so you can see that this is a really, really important. And Dale, we talked about this yesterday, right? We had the descending wedge in the 6J, and we drew it actually on this show yesterday, and you can see it in the dollar yen. It's really yesterday's low, and something that I told, you know, the ForexAnalytix community yesterday. I'm like, look, if yesterday's lows, which, you know, would be, I said it was today's lows, but that was yesterday. If those lows give way, then we know that the wedge is breaking. That should give us the you know, open door, at least from a technical standpoint. Obviously, you know, you'd want to see if there's anything happening from a you know, maybe from the BOJ's point of view, but this should open up a door to trade back towards the 50 DMA, or maybe even the channel support. But that's why the importance is really going to be yesterday's lows, because it is obviously going back to the 6J. It's the descending wedge resistance. I don't, you know, we'd had some there were some headlines that came out of Japan yesterday. I was running around. I was doing some honeydews yesterday, so I didn't get a chance to dig into some headlines. But were there some headlines that came out last night in Asia that got the market's attention? Ryan, Kman?
No, not really, mate. I mean, trying to water down a bit, perhaps, but UEDA didn't speak, so it's all opinions and officials coming out later. The one saying that he understood they were still going to continue to ease. Another comment, but it's just like those officials need to say something after the Bank of Japan governor says something. So not really. I think it's just the market not knowing where its head is right now. Really, I think yesterday's low was interesting. I showed that also on the flow show and in our room, just below 146 on the really short term. Yeah, now it's going to be guesswork. You know, we have don't forget, we have the other side of yen pairs that will be influenced as well. Tomorrow's US CPI, the day after the ECB, which can influence euro yen. I mean, there's going to be a lot of pushing and pulling before we even get to the Bank of Japan, right?
Right. And, you know, I know, just talking about the CPI, I mean, just based on what we were just saying a few minutes ago, I mean, the data is probably going to come in on the hot side. And, you know, do you really want to be short dollar yen?
Exactly.
Yeah, going into the data. As I said in the week ahead video, I'm looking to actually sell rallies in the dollar. So if we do get some hot data, let's say the euro presses below 107 and you know, trades down towards channel support down here at 106.50, which is the 161% extension of the last, you know, big bounce that we've seen. If we get down to 106.50, I'm going to be taking my dollars off the table, especially ahead of the ECB, knowing that, you know, as you're just saying here, there's a lot of landmines ahead of that, ahead of of everything. Actually, it seems like it's a lot of data over the next 2 weeks between CPI, ECB. We have the MPC and Bank of England next week, the FOMC. So much happening. Dale, you were talking about gold. Here's this is the chart of the day, and you can really kind of I mapped this out for you guys last week on the 5th. This is you can see the wedge that's developing. It's hard to be a precious metal bull with the dollar as strong as it is. Wouldn't you agree with that, Dale?
Yeah, I've been saying that for a long time.
Yeah, I mean, it's not like I'm a bear. I think that gold's going down to like 1,500, but it does look like we can continue to correct here back towards the 1885 level, which would be the previous lows. And I think that's what's kind of playing out right now. And you can see that you'd mentioned there's a little flag, and yeah, we start breaking today, and we're talking about in the chat room. It looks like we're going to head down here, and I think everything's going to be hinging on tomorrow's data. Really, it's going to be all about the CPI. So let me ask you guys this. Ryan, what are you focused on today? Are you just trying to focus on keeping your head out of keeping yourself out of trouble today?
Yeah, I might be getting myself in trouble. I've bought dollar yen at 0.4 on this break just to see if it goes. Yeah, I've just got the sniper rifle out, just going to be scalping away. See if you can make a couple of pips here, a couple of pips there, but I'm not looking for any rockets, anything.
Yeah, well, you might get a little rocket here on this breakout. So you're just buying the dollar yen just a little bit ago, right?
Yeah, 0.4. Just to give this break a test. It's, as I said, you look at the chart. It's been grinding up. It's been building for a bit of a pop, and let's see what it wants to do now.
Oh yeah, I see you said it in the chat room. You must have been doing it while I was speaking. You were. Actually.
Yeah.
Hey, look at the one just above. Look at the one just above where I bought dollar rand yesterday.
Oh, nice dollar rand yesterday. That's a good one. Let's take a look. So you're just exiting that dollar rand. Very nice, Kman.
Yeah.
Very nice. Just exiting it at the well, that's just an hourly chart, but nice little goose there.
Just a third off, because I'm planning on actually rebuilding some. But I'm keeping powder dry for tomorrow.
Yeah, look at that nice,
Exactly.
nice trend line, good wedge
ascending triangle.
Yeah, speaking of which, one of the other things if speaking of an ascending triangle, or I like to call them a bullish wedge, take a look at crude oil. Crude oil is trying to break higher out of a bullish wedge here. When you have consistent highs and higher lows, the next target that we have is the 89.50, and we are trying to break higher here. So now this isn't good for the consumer. This is not good for inflation. This move that we're seeing in crude, but crude, remember, the bull flag pattern that we have here really targets mid-90s. Do you guys see any reason why we can't trade to the mid-90s, or maybe even 100? What do you think, Dale?
I see no reason why not.
I mean, talking about Russia and the Middle East putting some upside pressure on crude, especially with the supply issues. It looks like it's going to continue to drive higher, which is not going to be good for inflation expectations. What do you think about that, Ryan?
I don't know how it does. I don't know how oil's up there in the first place, because it's not as if the demand is rocketing through the roof. So this is all manipulating it higher. Can they keep cutting production and holding production low and pushing the price up? Of course they can, but there's got to be a demand pickup somewhere, or they're just going to be pissing into the wind, as we say.
Yeah, it looks like we might get some pissing in the wind.
Yeah.
What do you think, Kay?
The OPEC report is just out, and they have calculated as after the Saudi cuts, there's a 3 million barrel shortfall. So that's usually putting some more upward pressure on oil, right? So
let's see your natural gas chart, like, because
yeah,
perhaps
let me I have it
because
right.
perhaps Europe isn't going to be as fortunate with a warm winter this year.
Where is
Sorry,
my natural
guys.
gas chart? There it is. It's you know, I mean, we've been basing for so long. Let's pull that up here. Yeah, I mean, we haven't done much, but I would venture to guess that we get above $3, and you know, it's going to be a rip roaring time.
What's
There's
the expression? The longer the base, the bigger the launch into space.
that's that is the first time I've heard that expression.
Okay.
And that's surprising, being that you and I have been working together for probably about 6-7 years now. So, but we are building a hell of a base there. Now, what do you think is going to cause a move up?
Weather.
Yeah,
Winter.
Winter is coming.
Yeah, winter is coming, and and remember, everyone was very worried about last winter in Europe, how people are going to freeze to death, and they had that very warm winter. So probably their guard is down because of recency bias, and now we'll get that move that everyone was looking for last year, but now they're broke, so they can't get long. That's the main reason.
Yesterday, Dale, I was on Trader Summit. I did an interview with Albert Marco, who does some. He's a geopolitical consultant for a couple of different firms, and I think he's somebody that you're going to really enjoy speaking with. I'm gonna set you up with Albert. He's a unique guy who has a lot of opinions about what's happening in Russia and Africa and everything else. So I'm gonna set you up with him. Yeah,
we have Tahir coming in Friday.
What's that?
Tahir is Friday.
Yeah. Oh, that'll be great. Deer Point Macro is coming in. That's awesome. Right. Got a couple of new people for you to check out. Anyway, real quick, let's take a look at yields and what's happening in yields. Excuse me. We have the US dollar, or excuse me, in the 10-year yield. What do you think is going to happen with yields here, especially on a hot print, Ryan? I mean, look, do you want to talk about wedging? I mean, here we are just wedging right into resistance. And my chart of the day yesterday was with the US dollar CNH. And you guys got to see this if you guys didn't see it. I know it's a correlation. It's more maybe coincidence than anything, but look at the US dollar CNH and the and yields. Yeah. I mean, it's the exact same chart. Exact same chart. I'll do it for you live here. So what do you guys think is going to happen with yields if we have a hot print tomorrow?
Higher.
Did Ryan?
Oh yeah, they're going to collapse, of course. No, of course not. They're going to go higher on a hot CPI number.
I have a target of 490, Blake, off the weekly chart.
Yeah, I think it's got to go some to get that. But I can certainly see some upside.
By year end maybe 490.
Oh, you're turning into one of the banks, Dale, giving a year-end call. I bet you get a better success rate than those clowns.
Oh, is that what they're saying? The banks are
saying? No, they just don't. They don't get any of their calls right. They flip-flop like you've never seen.
Yeah. Okay. Well, that's not going to help the banks or anything.
I mean, yields just look like they're pressed and ready to go. I'm wondering, just how much that influences not only the dollar CNH, but just the dollar in general. You look at charts that have very similar chart patterns. I mean, we could see a massive breakout here, and something to keep in mind. And that's the one thing that circulates in my mind about if the inflation data is hot, and you're long dollars, does the dollar follow through if you get yields really breaking higher, which, they quite possibly could.
You know what's
So,
amazing about that chart, Blake? Keep it there for a second. If you go back to the previous 430 highs, that was in October. That's where the S&P's bottomed at 3,400. Here we are attacking those same levels again, and you have 4,500 S&Ps. So
yeah,
think about how resilient or out of line the market is, one or the other.
one or the other. Yeah, it's be interesting. Hey, did you have a guest coming in today, Dale?
Andy's here.
Oh, okay. I didn't, we didn't see it on, I didn't see it on.
I tried twice. I went into Discord and requested that it go up there.
Oh, well,
but I heard Stell's been partying with AJ. So maybe that's
probably it.
Right.
Well, I'm going to tell everybody here then, as I'm going to let Dale take over. Make sure you guys stick around because you have the damped spring, right? Andy?
At Damp Spring, Andy Constant.
Yeah, and he's definitely somebody you guys want to stick around for. Ryan, Kman, thank you guys for being here. Thanks for keeping everybody straight on the Flow Show every day during European hours. And Dale, I hope you have a great interview with Andy. And Andy, welcome to the F.A.C.E show.
Yeah, thank you guys. Thank you, team.
Thank
you, Kman. Thank you, Ryan, Blake.
Nice,
real nice 30 minutes chock full of pearls. And here's a guy who'll give us some pearls. Hi, Andy. How are you? I'm
great, Dale. How are you?
Good. I've done interviews with you, Andy, where you have dropped enough pearls on me for June Cleaver to string a necklace. So, it's great to have you back. And I learned something from you last time we talked, and I'm hoping you could explain it to our viewers, listeners. You were negative the bond market, and a lot of people are buying 10-year yield bonds because of risk off. They think there's going to be a risk off event, a credit event, and that's going to turn the bonds. And you said not at this stage, Dale. You need a bear market in bonds to have a decline in equities. Can you explain what you mean by at this stage and how it could change?
Yeah, so I think in many of the stages we've been through over the last 40 years, most of our careers, we've had a credit event occur where some part of the financial sector or the real economy has been unable to pay money back to banks, and that's created a contagion, which has created a risk off. In those circumstances, bonds are, very attractive to buy ahead of that credit event because the Fed responds by cutting rates very quickly and the economy turns sour very quickly, inflation falls, and that's the typical cycle. But we're in a cycle like the 40s and 50s and 60s and 70s where inflation is the problem, not credit. And so to kill inflation, you have to kill demand. A credit event kills demand because no one has any money because no one's paying back money. But in an inflation circumstance, the only way to kill demand is to slow the economy by having employment fall. So when does employment fall? Employment falls when stocks fall.
Okay.
When the stocks fall, they fall when the discount rate for stocks, which is treasury bonds, rises enough so that the multiples start contracting. And so that's why in an inflation cycle, the Fed attempts to slow the economy by raising short-term rates up aggressively, hoping that will cause long-term rates to rise as well, which will then slow stocks, cause them to sell off, and then workers get fired and you have your slowdown. And so that's the script that I think we have to follow to have the slowdown that we need. Rates up.
So if you got into the business 10 years ago, you don't remember that the cycle could be the other way. because
Yeah.
it was always, you know, we didn't have an inflation issue. Can these attempts to slow the economy lead to a credit event? You don't think, I think, if I'm reading you right, you're not looking for a credit event.
I'm not looking for a credit event first.
Okay.
A credit
right.
event can always come, and we saw certain banks in March that didn't have a
Yeah.
credit event. They just happened to be long a bunch of risk-free, credit risk-less treasuries that went up, down in price. But the person that they lent their money to, the U.S. government primarily,
Yeah,
going to pay them back. They just bought too many at too high prices. And so a few of them went bankrupt. And so far, that's all we really see. And I think the regulators have been just like they crawled all through the LDI books in the UK, they've been crawling through the US banking books for, 5 or 6 months now, and drafting new regulations, more capital rules, all those sort of things. And so I don't think the banks are going to create that crisis that would cause bonds to rally quickly. That said, once you actually have a slowdown in the economy where people no longer have jobs and money becomes tight, at that point, companies that need to refinance may struggle and may not be able to pay back their loans, and that could cause a credit event. But that's well into a recession instead of the thing that leads to a recession.
Okay, interesting, because a lot of people thought that might be the fuse, a credit event. Instead of that's down the line.
Right, and I think that's right. The bond market is trading at a very low yield relative to the front end, very low term premium if you look at those sort of things, because there is quite a bit of demand for that recession trade. Stocks, on the other hand, are completely ignoring the potential for a recession. They expect earnings to grow 12% this year and 12% next year. And that doesn't happen in a recession. In a recession, earnings fall 20 to 30%, even in a garden variety recession. So the bond market and the stock market are definitely both bid up. And so the question is why? Yeah. And so my basic point of view is that it's been because the government, the US government, has been spending money that they borrowed in 2022 and are not raising until just recently. They're spending down their Treasury General account, which is their checking account, because of the debt ceiling. And that's infused money into the economy, keeping it strong, keeping assets high, and also not issued any assets to suck up that supply. That all changed August 1st. And I think that's what has that's why I got short long-term bonds, why I'm still short long-term bonds, and why I think that trade will be the trade for the month, the balance of the year.
Okay. I wanted to ask you, because you talked about that we're not too far from a terminal rate, but I have a technical target in the 10-year yield. This is 409, okay, and this is 323, 330, and we broke out. We even tested it this week, 2 weeks ago, 409. It actually measures 495. So the breakout was at 409. It tested the breakout at 409, and it's been heading higher. And the measured move of this formation is 495. Can you come up with a fundamental reason how the 10-year could get to 495 to back up what I see technically?
Well, as you know, I think what has to happen for that to occur is, one, the supply is probably worth around 30 more basis points before 10 years become attractive as an asset relative to cash, which takes us to like 460. I think to get much farther than that, you're going to actually have to see inflation reaccelerate. And we could get, I don't know what the print's going to be. It could be hot or cold. But if you got a hot print and then that continued to be supported by ongoing data, sure, you could see that level. I would be a big buyer at 495. I think that's too far, but certainly 460 would make sense to me.
What would that translate on the TLT? 86, 88?
So that's another 30 basis points on a 17-ish duration. So that's like 5 points-ish.
Okay, 88.
Yeah, call it that.
Yeah, so it's just taking out the October low by a shade, and that might be it for a while.
Yeah, again, it'll be dependent on data, but that's sort of the direction I think that you start thinking about being a buyer of TLT at, when you sort of see below that October low.
Okay. Also, when I talked to you, you said the yen wasn't done, and we did rally. Okay. When you talked about it, we got a rally back to new highs up here. Okay. And then Sunday night, something happened. Right?
Yeah, there's a lot of saber rattling. And, if I don't have a position right now, but if I was short, short yen, I would be concerned about intervention. And right now we're just getting a lot of saber rattling. But, at the same time, I think there's, they're going to prove that there's actual intervention behind the saber rattling. So, I think right here, you're at that danger zone where we could test 150, but then you could also wake up one morning and it be at 145 on heavy intervention. So I think we're in that sort of danger zone. But that said, intervention doesn't work, and the situation for Japan remains that they need to stay easier than the rest of the globe for a long time because of their overall economy, and probably also do some fiscal spending. And I'm bearish the yen. I think we're going to go well through 150, but right now we're in that danger zone where an intervention can have you trigger stops or wipe out option premium, or however you express that view.
Okay, I know that you're also a trader in the precious metals. So gold's been under pressure today. I think we were talking, it was, in here. What do you think?
Yeah, so
in this environment.
Right. So I work with Jimmy Jude pretty carefully, and he looks at the technicals on this sort of thing. And, we were fairly optimistic about gold against as a hedge to short bonds in this last technical, buy. This one looks a lot weaker to us. And fundamentally, I see no support for gold right now because of my bearish view on real interest rates. So I think I think this one is, if you do get a sort of bullish setup, which I don't think I see there, but if you do get a sort of bullish setup, I think that's when you want to fade versus going long gold at this stage. I don't have a position, but if gun to my head, I'd be short.
People are asking what would be the catalyst to take it down to 1800. And I want to see if you agree with me. I think it could be another wave down of risk off. We're, having some trouble here in the S&P at this 4,500 level. This pretty big pivot. If you look left and then here. So if we stay under 4,500, get another wave down, gold and S&Ps have been trading like they're cousins.
Yeah, I mean, I think that's just a reflection of assets in general and this very bid up environment, undersupplied asset market. And whether it's the 10-year note going to 460 or the S&P trending toward 4,200 or gold making these sort of levels, I think it's all the same trade, which is there enough liquidity being provided by fiscal spending to offset the supply of bonds as quantitative tightening starts coming in? And my view is no. And so I'm fairly bearish all assets. My only trades at this stage are in the US are in equities and bonds. I'm short them both.
Okay. So I know I brought up asking you about the BRICS. And you said it's just a distraction for you.
BRICS, the Russian
the currency, the currency that the Chinese launched was just a distraction.
Yep.
Are CBDCs more than just a distraction, the biggest monetary story and change since Bretton Woods?
Yeah, I mean, I think that there's so much time they're worth talking about, and the implications and how you could manage the economy with changing the returns on CBDCs. But at this stage, I think they're a distraction from the standpoint of there's so much more work to be done before we actually have one.
I'm hearing they'll be rolled out second quarter of next year.
In which country?
Here.
Really? That would surprise me. It would disenfranchise the banks in such a meaningful way.
Right.
I would be cautious making that bet.
How long do you think it's going to take? Because if we have more time, why isn't there more pushback against it?
I just would say
that's really why I'm bringing it up. There isn't any, no one's talking about it because
it's really not my lane. It's really not my lane in terms of, it's not something I focus on.
It's going to be everyone's lane, Andy, because everything we do for a living and everything is going to be affected by it. So no one gets a pass on this one. We're all going to be part of it, whether by consent or not. So I think, why aren't people talking about it?
Again, I'm not really sure. It's not my area of expertise.
Anyway, I'll take a tranquilizer and calm down about this. There's some lithium, but to me, it freaks me out, the whole thing.
Yeah, no, listen, the idea that one could charge a negative interest rate on a digital currency and force people to spend, that's a new level of government involvement in our lives. And so it has to be considered very carefully before something like that happens.
Well, I hope it is. Peter Bookvar said there'll be a lot of resistance. I just haven't heard it. So let's talk about the here and now again. So basically, it's time to either be in cash or be short.
Yeah, that's my general view. It's always time to be long for the long-term investor. But even in such a circumstance, I have the biggest allocation in my beta, sort of retirement long portfolio that I've ever had.
Okay. So everyone owns Apple. What should they do? I mean, they own it either in a 401k or an ETF, but everyone's long Apple.
Well, I mean, everyone's long Apple if they're long the S&P 500, if they're long the QQQs, and some people are long Apple.
Will the new phone save this chart, you think?
Geez, I can't say that I've been right on tech. I've definitely missed the AI phase, but I certainly wouldn't be buying any of the Magnificent Seven here. It is interesting if you look at the NVIDIA charts and the Apple chart, it's really only the Magnificent Five right now.
Interesting point. Okay, so the narrow is becoming narrower.
And it seems like that to me.
And what's interesting? I was talking about this during our show earlier. The S&Ps rallied almost to 4,600 was just a layup from new highs before it was turned back. And Microsoft hasn't even recovered half of its losses after this sell-off. So is this part of the Magnificent Five?
Yes, it is.
Okay. Well, anyway, I think we might be down to 4 if this is a failing rally up here. And
that'll be the thing. I think, these stocks are I certainly prized, highly valued. I don't think there's much short interest relative to their size, of course. So it'll be an interesting test for the market. If, right now, the Russell, for instance, is really struggling. And it's becoming more narrow and more in these stocks. That's just ugly, Russell.
Look at that sideways. There's a weekly sideways since the bottom.
Yep.
In April.
Sure is.
Yeah.
Yep. Sure is.
And that's America.
Yeah, more so.
Okay. So I mean, what's it saying? Doesn't look like happy days are here again. Is a big part of this regional banks too?
Regional banks have done very well lately. If you go back to March on the KRE, you're going to see a stock market that's up 20% from the lows.
Yeah.
That's not
I'm sure.
now. Now, admittedly, there's been tremendous headwinds on the banks, and those are starting to infect the money centers as well. And obviously, down 30% from the highs. But these banks had some serious headwinds. But if you look between April, the lows.
Yeah, here we are.
We're doing pretty well relative to the S&P.
Till last week.
Yeah,
and,
the market started selling off.
Yeah, it's my contention that this is not the low, that this was just a little bear market rally, a weak one, in fact, to 38% back, and there's another shot to the downside. And you're right.
Again, if the 495 makes sense on the 10s, the KRE has to test those lows.
Okay. All right. So Andy, I saw that you did an interview, and the headline was lower rates create the risk of assets exploding. Okay, so it was on Real Vision. Okay, that was the headline of the interview. Were you talking about that if the Fed ever, when they begin to ease, that they won't ease now because they don't want to see assets explode to the upside? Was that part of it?
I guess the question, I'm not really familiar with what my quote was on that, but certainly if the Fed were to ease too early, that would be really bad for long-term bonds because inflation had come back, but actually pretty good for stocks and gold.
Okay.
I don't think they will ease too early, but that would be what I would mean, that if the Fed gave up on its inflation mandate, there's no bottom for nominal for bonds. TLT could be in the 70s, but equities and gold would be the place to have your money because inflation favors those two things, commodities as well.
Okay. Do you think they might give up this fight by the spring of next year? Do you see any signs down the road that they'll turn or is higher for longer, take us into 2024?
I've been higher for longer for a long time, since almost over a year now. And I still am, but I do think that we're now in a pause phase, and that pause phase may work out if this bond supply takes long-term yields higher and that mechanism starts working. But if it doesn't, they're going to have another hiking cycle. And at that point, who knows how hard it goes. But, I think it'll all work out if we get an unemployment rate that starts, if we start seeing negative NFP prints, which I don't expect till the first half of next year. But if we start seeing non-farm payrolls go negative and start really losing jobs from the economy, I think they'd be, they're close or done. But the pause, I suspect, will be quite long before they give up. Powell said there'd be pain a year ago. Yeah. The unemployment rate is exactly the same.
Right. So there really hasn't been any.
There's been no pain whatsoever. So it's very hard for me to believe that even during an election that there'd be enough pain for the Fed to cave on their inflation mandate. And particularly if energy prices stay high. I noticed you talking about oil. I do have some out of the money oil calls for December.
It looks pretty good.
That I like. But
up another $1 today.
Yeah, if we get $100 oil and natural gas, I noticed you quoting Louise Yamada, who I think
but she took it from me.
Oh, did she? Yeah.
I in fact I should sue her over it, but I won't.
All right, fair enough.
All right, go ahead.
But if those two things kick in, that puts the doves in Congress back on their heels for any political pressure. So I think it's a tough game, but I think we're in a position where the Fed will, where the things are lining up for us to actually have the sort of demand destruction over the next 9 months and then recession that kills inflation over the following 9 months. At least. And, I think that plays out well, but we never know.
You're right. Anything and everything, count on it happening, Andy.
Yeah.
And and thanks for going everywhere with me
Sure.
today. I
Good
mean,
to speak with you.
even my off base tirade about CBDCs. So I appreciate it. I learn from you every time, Andy. So people follow Andy, and look forward to his service with another great trader, Jimmy Jude, and follow him at Damped Springs. You guys have a website set up yet?
Yep, dampspring.com.
Okay, so go check it out. And you've launched your with Jimmy?
Oh yeah. He just joined my existing team, which has been a great ad.
All right. Well, congratulations and good hunting, Andy. Thanks so much for sharing your views with us.
All right, Dale, I appreciate it. Talk to you later.
Respect. Adios, Andy. All right, everyone, that's a wrap. Could join the team on the Morning Edge in 20 minutes. Good luck today, everyone. Did you like Andy? You're welcome, Patrick. Yeah, I learned from him because, I kept looking for maybe bonds to rally during a risk off thing, and we're just not there. So he's part of, it's good to talk to smart people. Anyway, guys, have a great day. See you tomorrow. Don't just count your pips, count your blessings. Adios. You're welcome.